Today we're going to talk about a topic that we all love to hate, and that topic is Wall Street. And you know I talk about Wall Street because one thing that we need to understand is that hedge fund managers are playing a completely different game than the rest of us are playing. So a lot of people, especially on YouTube Finance, these finfluencers, if you will, God, that's a stupid name, but they like to talk about what these big guys are doing. But the problem with doing that is that these guys' incentives are way different than the rest of us. And you know the example I always love to use is Cathie Woods. And I'm not trying to pick on her, it's just that, she was the hottest topic for about a year. So we'll talk a little bit about Cathie in this video, but we'll also talk about another hedge fund that just blew up. Well, technically they didn't blow up just yet, but it's pretty bad. And that hedge fund is Tiger Global. And long story short, they basically got screwed by their enormous tech bet because all the tech stocks got crushed. And years worth of their gains have been vaporized very quickly in just 1 year. So Tiger Global was like another ARK Invest, but they just weren't as popular in the retail sphere like Cathie Wood was. But they were basically doing the same thing, investing in all these tech stocks that, had huge valuations, barely made any money, but it didn't matter, right? Because during that time, they were all shooting up. So Tiger Global had two main branches. They had their hedge fund, which was trading in public markets, so like the same stocks that Cathie was in. And they also had their private fund, which was more involved in venture capital, which during that time was also booming like crazy. So as you can imagine, both sides of their business got absolutely crushed recently. So Tiger Global said in a note to their investors last week that its hedge fund, which managed $23 billion at the end of 2021, was down 52% this year. That is one of the largest ever losses by a hedge fund, period. And its other large stock fund, which was a long-only fund, meaning they only buy stocks, that managed $11 billion at the end of 2021, and it's lost 61.7%. And the reason their main fund is down less is because they're able to short stocks in that fund. So they sent a letter out to their investors saying, yeah, most of our tech stocks have been crushed, but now we're shorting those same stocks. So we'll see what happens. Good luck. So by the end of April this year, that huge tech bust that happened wiped out roughly 2/3 of the gains that Tiger has made in those stock funds since its founding. And its founding is back in the early 2000s. So the guys who run this fund are proteges of Julian Robertson. And you know him from Tiger Management, that famous fund. So when he shut down his fund in 2000, he seeded a bunch of his proteges, including the guy who started Tiger Global. And this guy Coleman was only 25 when he started it. And he did pretty well until, now. But okay, so they got 2/3 of their gains wiped out in their public hedge funds, right? But they also had their venture capital side. And that fund was valued at $64 billion. Now on that side, you won't know exactly how much it's worth now, because it's all private, or a lot of it is anyway, but a lot of those companies that have been funded, there's been a huge slowdown in the venture capital space because this tech slowdown hit all these private companies too, right? So now, instead of massive growth, which they were focused on previously, now they're trying to lay off people and kind of generate cash so that they could survive through this cold period. And that's a major problem for valuations, because how do valuations work? You end up valuing something based off how much you think it's going to make in the future. So the best example, and this is of a public company, is say Tesla. So okay, you think Elon is going to completely change the energy landscape. Great, that's a 10x valuation from what it is now. Oh, but also he's going to colonize space. So I guess that's a 30x valuation from where it is now. And you're basing that off of what? Wow, colonizing space, he's going to make so much money. So what would the stock be worth now, considering that that's in the bag? He's definitely going to make all that money. And that's how Tesla's stock price shot up like it did. Same thing happens in the private space. Okay, this company is only making $3 a year right now, which I'm sure actually isn't too far off from the truth. And for a lot of these companies would be a huge win considering how much money they lose every year. But the idea is, no, we're not going to value these companies off what they're making right now. What are they going to make in the future? What is DocuSign, the future of signing documents? What are they going to make? Oh, well, the market is infinite, right? Everyone needs to sign stuff and the internet is huge and yeah, billions of dollars. And again, DocuSign, another public company. But the point is, for these private companies, those valuations based off their growth became huge. So same thing you were seeing in both spaces, public and private. But as soon as they start switching to preservation and not focusing on growth, well then all that air in their valuation, it comes tumbling down, just like it did in the public markets. That's why you saw these companies drop 90% and more. So large venture capital firms are warning right now of harsh times to come. And of course, every VC that I follow, they already know that too. They've been writing about it for a while because they knew there was way too much money flooding into that space And this Tiger Global that we're talking about, this is one of the guys pumping all that money in there. And I'll tell you in a second why. It's because their incentives are way different than the rest of us. But let's keep going with the story first. So their venture capital business in March to raise a $12.7 billion fund. This was one of the industry's largest funds ever. And the way it works in venture capital is that you raise separate funds. So you raise $12 billion right now and you're going to go invest all that $12 billion. Then you'll have fund number 2 where you raise another 10. Then fund number 3 where you raise another 10. And basically it works like that in venture because that money that you put in, or the investors put in, it's going to be allocated to companies where you might not see a return for 5 to 10 years until that thing IPOs. Basically until you could become liquid in that investment, and it takes a long time. So they do it in separate funds. So Tiger, after raising all that money, invested in 361 deals in 2021, which is an insane number. You could just compare it to their 2017 where they only had 16 deals. So that 361 deals in 2021, that's more than any other US manager. They were going wild. And why? Well, because they raised so much money. So they would outflank other long-standing venture firms by moving faster and agreeing to more generous terms with startups. Sometimes they would offer money to companies hours after meeting them. And what's that tell you right there? Do you think that Tiger Global is really doing their due diligence? Are they really being careful with everything that they're investing in? No. Basically, what Tiger Global was doing was taking like an index approach to venture capital, which is kind of stupid. But okay, I'm not a venture capitalist, so I can't really say it's stupid. But based off what other venture capitalists do, it's very different. Because other venture capitalists, they are very specific in who they're investing in, and they get involved a lot too. So they'll sit on the board, they'll work with the CEOs because they have the experience, right? And a lot of these CEOs of these startups, they're young and they need guidance. But in Tiger Global's method, what they did is give all these companies a bunch of money and then step out of the way. They're like, oh, you do what you need to do. Which the way they spun it is like, hey, we have full faith in you. We'll give you all the money you need. We'll make any connections you need, but you do your thing. But in reality, what it is we don't really care. Like we're spreading our bets everywhere. So many times Tiger Global would be backing one company while backing their competitor at the same time. Because they don't care. And when you have so much money like they were raising, doesn't matter to them. If one of them succeeds, then they'll make their return. But here's the thing, like a normal venture capital company will make a bunch of bets with the expectation that 1 or 2 will turn out really well and then cover for all the losses in the others. And I guess that's kind of what Tiger Global was doing, but at the same time, it seems like they were making just a giant macro bet on the space at the time. And that's basically a giant tech bet, right? Because stock prices and the private company prices were just shooting up like crazy. So what was their strategy there when you take an index approach to venture capital investing? I don't really know. Apart from the idea that, hey, everyone's just buying these things up like crazy, valuations are going up, let's just put money everywhere. Again, a macro bet. Tiger would even outsource much of its background research to Bain. And Bain is the famous consulting firm like McKinsey and stuff. So the analysts at Bain would interview customers and create dossiers on prospective companies. Is it dossiers? Did I say that right? It's my Indian accent. It just makes things tough to pronounce, you know? But Tiger Global was so excited to spend this money that they didn't even do their own research. They just hired it out to Bain. It's crazy. But as you'll see in a second, it works for what their incentives are. So on the private venture capital side, you see they're doing crazy things and it's going to come back to bite them in the ass. Once those numbers come out publicly, we'll see it. We haven't seen it just yet, but we do already see it on the public side in their stock investments. So one example is when Tiger built up a stake of more than $2 billion in Snowflake in late 2021. And you guys remember that company Snowflake, right? I think I even made a video about them because they were so hot on YouTube. Every YouTube finance guy was making a video about them and you would get a bunch of views. And Tiger built a stake of $2 billion. And you can see what happened to that stock. It's down over 70% now. And when they invested, its market capitalization was around 100 times its annual revenue. 100 times. So historically, software firms have been valued closer to 5 times their revenue. So Snowflake, Zoom, DoorDash, these are all companies that Tiger invested in. And now they're down all more than 60% since November. Carvana is another one that they got into. And this was a hot one on YouTube as well. That's down more than 90% from its highs. So during that time, you remember 2021, it was pretty much a cluster, right? You had Cathie Wood having all these people invest with her into these high-flying stocks, and you had other hedge funds doing the same thing she was, like Tiger Global. And there was no secret to it because everyone on YouTube Finance knew about it too. We were all investing in the same stuff like idiots. That's honestly part of the reason why I took a break from YouTube for so long, is because I just got sick of so many people being on the platform talking so much BS and everyone saying stuff like they actually knew something. I'll tell you right now, very few people actually know anything. I barely consider myself as a guy who knows anything. Alex from Macro Ops, he's the guy who knows stuff. I would consider myself kind of a middleman where I could kind of see who knows what they're talking about, which is actually a skill. I mean, it's a reason why they have fund of funds. And a fund of fund is when you give your money to a manager who finds other managers to manage it. And why do they have that job? Well, because it's so hard to actually find someone who's good. So you need to find a person who can find someone who's good. It's like 2 steps removed. And because I have a good BS detector, at least in business and in the markets, I could tell who's full of it and who's not. And there are only very few people who are not full of it. And these Tiger Global guys, so this little white dude right here, looking a little pasty, actually looking a little leprechaun-like too. But him and his partner right here, look at that $1 million white guy smile. But I would say that they're sort of full of it. Because the big thing we got to realize with Wall Street and hedge fund managers like this is that their incentives are different. And you know I've talked about this a lot. So you could see that these guys' number one goal, based off how many deals they were getting into, what stocks they were getting into, and most of all, how much money they raised, you know their number one goal is to raise money. Because they are going to make all their money based off raising capital. Because how do hedge funds work? They have a management fee, right? And even though it's a small management fee, when you have billions of dollars, you become a billionaire very quick. And both of these managers of Tiger Global are billionaires. And they did have success in the market, there's no doubt about that. They did pretty well. But you can do pretty well for a period of time and then absolutely collapse because you're just making a big macro bet, like in this case on tech, without any risk control in place. But when you're in that position, you don't actually have to care about risk control, because you're managing all these other people's money while you're still getting paid on the management fee. So I say the same thing about Cathie Wood all the time. She did a good job becoming the number one retail god and having all this money flow into her because she made the huge bucks, and by the time everything collapsed, she's fine. Just like these guys, even though they lost all these investors' money, they are absolutely fine. See, the duo are multi-billionaires. So Mr. Coleman, he paid $36.5 million for an apartment on Manhattan's Upper East Side in 2008. And he subsequently combined it with his $52 million apartment 1 floor down. Very rich. And Mr. Schleifer, am I saying that right? I don't know. He bought an $18 million Upper East Side apartment and early last year added a $122.7 million oceanfront Palm Beach, Florida mansion on land once owned by Donald Trump. And he got that in one of the most expensive home sales of all time. $122 million. That is nuts. So he travels the world in a Gulfstream previously owned by Steve Wynn's Wynn Resorts. And that's whatever. You got a bunch of money, do what you want with it. But the point is, well, to a certain extent, but the point is that losing all that money in the market doesn't affect these guys because they already are paid out, which is very different from the rest of us. So if you try to follow Cathie Woods or Tiger Global into all these stocks and then try to hold on because they were holding on, well, can you imagine losing 60% of your net worth? Yeah, it'd be horrible. And that happened to a lot of people. And that's why it's tough to trust these hedge fund managers or even financial advisors. Because your local financial advisor, you know what his incentives tell him to do? Raise as much capital as possible. So these guys, they all focus on raising capital, which is taking you out to a nice dinner and doing and saying what they need to say to make you write a check to them, instead of actually focusing on returns or risk management, which we always focus on this channel. So if that's their incentive, of course, you're going to get hurt when you invest your money with them. Now, this isn't everyone, of course. There are a few guys that are very good in both financial advising and in the hedge fund world. But for the most part, you know, it's probably not a good look. And if you're watching this channel, you probably already knew that. A lot of you guys have gone to financial advisors and not had a good experience. So it sucks because you're pretty much forced into the stock market and you got to manage it yourself. And that's why we've done what we've done over the last few years and introduced you guys to all these systems. So at least it's somewhat automated. It's still not easy because you still got to watch your money go up and down, but it's as easy as we could possibly make it in terms of investing in the stock market. Now, Tiger, even though they lost all this money, you know what they're doing? They have begun talking to investors about raising their next fund. Because that's the game. Get it while you're popular. If you blow up, it's okay. Like I always tell you, Bill Ackman has blown up multiple funds, but he keeps coming back because he's got a good story. You've seen so many tech companies over this past bull run that have just blown up for no reason. WeWork, that's one of them. And you know why they did so well? Because their CEO could talk really well. They could sell a story. And if you could sell a story, people are going to pay you a lot of money. And that's all capital raising is too. So you really got to watch out who you're paying attention to, and you got to think about what are their incentives. Even what are my incentives for publishing these YouTube videos? Obviously, I don't do it for my health. We publish videos like this and we get very specific clients in both MacroOps and Fallible who pay us to either use our systems or get our research. And we got a nice small little capitalistic system that works out for all of us. All of us are happy. And you can tell by how small our YouTube channel is and even how small MacroOps is, we are very niche because there are not many people that respond to more reasonable stuff, unfortunately. But we do our best. And I appreciate you guys watching all the time. And speaking of good stories that people tell to raise money, the recession is one of them. There's a lot of debate about whether we're heading into a recession or if we're not. And our latest research dives into that. So if you want to see that, click this video right here. It's probably not what you think. So click this here and I will see you in that video.